Hello and welcome to session 16 of our Series 7 exam overviews, brought to you once again by Passing Score, where you can get more help on your exam prep at PassingScoreFinance.com. In this video, we'll be going over agencies, which are very important since they issue hundreds of billions of dollars of securities every year and focus on low-cost financing and services for a variety of areas. So let's start with what an agency is. We have federal agencies which are direct arms of the U.S. government, explicitly backed, and GSEs, which are publicly chartered and privately owned for specific purposes. They have implicit backing, which can, as we saw, turn into explicit backing from the U.S. government under certain circumstances. Let's look at some of the major agencies. We have the Federal Farm Credit Bank, which provides lower cost financing for agricultural and farm producers. They issue short-term securities, which are usually exempt from state and local tax, but subject to federal tax. We have the FHLB, the Federal Home Loan Banks, which provide liquidity to financial institutions. Basically, they offer lower loans, lower interest rate loans to financial institutions in order for them to stimulate lending for mortgage, small business, and rural purposes. We have Sallie Mae, which provides liquidity for providers of student loans. Again, these agencies don't directly do the loans, but they stimulate loan providers for these different areas, in this case for student loans. And they maintain a line of credit with the US, but they are not directly backed. We have Freddie Mac, which is the Federal Home Loan Mortgage Corporations. Again, they facilitate financing for new housing and they issue what's called participation certificate and guaranteed mortgage-backed certificates. We have Fannie Mae, which buys FHA, VA, and conventional residential mortgages from lenders. And the idea there is to get cash back into the lender's hands in exchange for those loans so they can go out and provide additional loans to qualified borrowers. Again, this is not they aren't explicitly backed by the U.S. government, and their interest is subject to federal, state, and local taxes. We have Ginnie Mae, which provides financing for residential housing, and they're directly under the Department of Housing and Urban Development, so they are an actual government agency explicitly backed by the U.S. And again, they issue mortgage-related securities. We've mentioned pass-through certificates once or twice, so let's define that for you. A pass-through certificate is a security that's made up of a group or a pool of mortgages so that the payments on those mortgages can go directly to investors, a less servicing fee. So this is a way for investors or ordinary investors or institutions to actually buy the payments from mortgages. And again, this provides additional financing. When they're buying those bonds, they're providing cash back to the issuers so they can lend more and provide liquidity and financing to the market. But a pass-through is basically just a pool of mortgages, and as the name implies, all the payments pass through a mortgage servicer, which pays out every month to all the bondholders. There are some risks, even though mortgages are generally low risk under most circumstances. There's prepayment risk in which mortgages can be paid back too quickly, more than expected, so that you don't get the return that you thought you would, or on that for that interest rate, and you'll have to reinvest that money much sooner than you expected. There's also extension risk, which is the flip side. Uh, let's say that you have a lot of mortgages that are in your bond, and interest rates shoot up. So now you're stuck with a lower interest rate than you can get in the market if you bought a new bond. but those borrowers aren't going to be paying back those low interest rate loans nearly as quickly as they would have. So the life of the average loan increases, which is called extension risk. A CDO works similar to these pools of mortgages, but they can be any type of loan, commercial loans, commercial real estate loans, other bonds that are pooled together and then sliced up for investors in different priorities. So there can be a high priority, and by priority, I mean they get paid back first so that they're very low risk and they'll have a lower return, and those layers are called tranches. So you can have a lower a priority or the last priority, which will be very high risk, but has the potential for a higher return. And these structures can get very complicated. And we have something called a CMO, which again is a pool of mortgages. And the difference between a CDO and a CMO is CMO is just mortgages, but the similarity is that it has that structure. It can have a lot of tranches and a lot of rules around those tranches to create bonds out of a pool that are some that are very low risk to ones that are very high risk and just about everything in between. There's a way to measure the prepayments on these types of pools of loans. It's called the PSA. And this is a standard benchmark that people use to talk to each other about how fast the prepayments are occurring on a pool of loans. 100 PSA means that the prepayments are following the model exactly, which is not very common. A 200 PSA means that prepayments are coming in at twice what the model says. And a 50 PSA means they're coming in at half the rate that the model says. The model isn't used to predict, it's just a standard way to talk about the prepayment speeds. And here's a visual of how that looks. The PSA standard model says that there's going to be a 0.2% increase in prepayments every month during the first 30 months. This isn't the contractual principal payment that's in the loan agreement. This is prepayments amounts in addition to the standard uh, loan principal that should be paid back with the loan. So this is additional prepayments. And that flattens out at 6% after 30 months. So we can see 100 PSA is 6% there. And a 50 PSA means that it's going to start prepaying at half the rate. And we have a much lower line there at 3%. It'll start to flatten out. So that's basics on the PSA. There's different CMO types. And as we mentioned, with those pools of mortgages being sliced into different tranches, we can make a lot of different rules which for particular purposes. We have PACs, TACs, Z tranches, POs, and IOs. So we'll explain these in the next few slides here. A sequential pay means that there's just a straightforward A, B, and C tranche. First, all of the principal on the A is paid down, then all the principal is paid back on the B bonds, and then finally we'll have a last tranche that will have the highest risk because they're last in line to get the principal pay down. Now, with a PAC, we have an attempt to stabilize the prepayments that are being received by the bondholder. The volatility of prepayments can make things difficult for an investor to plan ahead and to have some stable rate of return. A PAC is designed to overcome those problems by overflowing any prepayments above what's expected into what's called support tranches, or to pool principal from other tranches so that they receive their payments as expected. So it makes things much more stable for this type of investor. It's not foolproof. If prepayments come in way too fast or way too slow, I can still throw off the plan, but it does make the pack much more stable than Sequential Pay, for example. A TAC is similar to a PAC, but it only protects on one side. It only protects against prepayments occurring. But if payments come in slower than expected, there's no protection against that, which means that there's extension risk. The life of the TAC can extend, but it won't shorten more or has protections against shortening more than expected. Now, we've mentioned the support or companion tranches, and they're called companion tranches because they're attached to a PAC or TAC in order to absorb that overflow of prepayments when they come in faster than we want them to. So this makes these risky, volatile cash flows because they depend on uh, what prepayments come in. And this makes for a higher risk security, certainly, and but it does get a higher yield. We have the Z tranche, which is always the last tranche to get paid back in a mortgage pool. So it might not receive any cash flows for a while. The interest just compounds to be paid back later. It's deferred, and then it'll receive that at the end after all the other tranches have been paid back. So it'll have the longest average life and certainly the highest risk. We also have seen that these cash flows from these pools of securities or bonds can be sliced up in a lot of different ways. So another feature, uh, another way they can be sliced is to separate the cash flow from principal payments to interest-only payments. So we have, for purposes of the exam, remember that if there's a fast prepayment speed, this will result in a higher yield for the PO. They'll get their money back quicker in a shorter time, which directly correlates to their rate of return. So they might have been expecting a certain amount of money over a year, but if they get that in 30 days, that means their return was much, much higher since they got that return in a very short time. The flip side of that is the interest-only strip. Now, prepayments. Now, if we, as we see, that volatility always has to go somewhere else. So this is where that the flip side of that positive for the PO is a negative for the IO. A faster prepayment speed will result in a lower yield or losses for the IO, since there'll be less interest paid when you prepay your loan much faster than expected. That means there's less interest income for the IO strip, so they'll get a lower yield, and that's where that potential for loss comes from. We also have what's called a floating rate tranche. This is a tranche that's tied to an interest rate index. So if LIBOR increases, your return will increase as well, and it's subject to some caps and floors, some limits on how much those can change. And again, we're going to have that volatility offset in a different place. And that's what an inverse floater is. It moves in the opposite direction of that interest rate change. And this is something that maybe a hedge fund or someone with very specific risk needs might invest in. Now, with all these types of complicated bonds, we have to be very careful, and there have been a lot of rules set up around communicating and advertising these types of investments to the public. So we have rules for CMO public communications, which say that all claims must be accurate. You can't make direct comparisons with CMOs and other types of investments. You have to say what it is in the ad or communication brochure, whatever it is. Any ads have to be filed with FINRA, and there's lots of other disclosures, and they have to be all be approved by a principal as well. So, as a Series 7 stockbroker, you have to be aware of these specific rules for CMOs when you're communicating with the public. Education materials have their own rules as well, so you have to describe what the characteristics and risks of the CMOs are, the structure, the relationship between the mortgages themselves, those loans, that people have taken out to purchase their home, and the pools of securitized mortgages, which are being sold to the public in the form of those bonds, CMOs, MBSs, and CDOs, as well as providing a glossary of MBS terms such as the PSAs and how those prepayments can affect your yields. That's it for our agency section. If you have any questions at all, please feel free to email me at john@passingscorefinance.com, and good luck on your exam.